So look, I will just say that it is up to the administration and Congress to decide on appropriate fiscal policy, and our job is to maintain our focus on employment and inflation. We continue to think, as you can see from the projections, that a gradual path of rate increases remains appropriate, even with almost all participants now factoring in their assessment of the impact of the tax policy. It is projected that the tax cut package will lead to additions to the national debt and boost, by the end of the horizon, the debt to GDP ratio. And I will say, and this is nothing news, it's something I've been saying for a long time, I am personally concerned about the U.S. debt situation. It's not that the debt to GDP ratio at the moment is extraordinarily or worrisomely high, but it's also not very low. And it's projected, as the population continues to age and the baby boomers retire, that ratio will continue to rise in an unsustainable fashion. So the addition to the debt, taking what is already a significant problem and making it worse, it is of concern to me. And I think it does suggest that in some future downturn, which could occur just for whatever reason, the amount of fiscal space that would exist for fiscal policy to play an active role it will be limited, may well be limited.
Sam and then Victoria.
Sam Fleming from the Financial Times. A couple of longer-term questions. First of all, midway through the year, you talked about the issue of whether inflation targets might need to be raised. There's obviously been a lot more debate in the Fed's system since then about this. It may not be an imminent issue, but do you expect it to be something the Fed should be discussing over the coming years, some sort of change to the inflation target? Second of all, the amount of stimulus tools that the Fed may have at its disposal when the next downturn strikes are fairly limited. One of the incoming governors, Marvin Goodfriend, has talked about the merits of negative interest rates. I just wondered whether you see that as a potential tool, at least in theory, for the Fed to consider should it run out of other options. Thanks.
So right now, the FOMC is not discussing or considering its inflation target. We do see inflation is likely moving up to target over the next couple of years. And I would say, you said our stimulus tools are limited. I would want to emphasize that if there were a negative shock to the economy, we do have some scope to cut the Fed funds rate. And there are other tools available, ones that we have used previously, forward guidance and asset purchases. So I think we're not out. I wouldn't say that we're out of ammunition, but certainly it's been recognized, and I've emphasized myself, that in the longer run, we may be, and we'll have to see how this works out, but we may be in low interest rate environments where it could prove useful to have additional scope to conduct monetary policy. And in that context, I think additional research, the academic economists and others are thinking hard about what more could be done, and I think these are matters that are certainly worthy of further study.
So you do believe that negative interest rates, at least in theory, are possible in the U.S. at some point if it should be necessary, at least in theory?
So, I mean, on that, I would say that's not something that we have studied inside the Fed to any considerable extent and haven't seriously thought about using ourselves during this last downturn and recovery. We have watched what's happened in other countries. I think that's worthwhile, and I would say it's an area that academics may have interest in the future and is worthy of some study, but it hasn't been part of the Fed's agenda.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.